Hello everyone and welcome to a new ATFX video. My name is Gonzalo Canete and I'm here just to share with you a new episode, new podcast. In this case, in this occasion, we are with Drew Niv, Chief Strategy Officer of ATFX from Florida, US, today with us. And hello Drew, how are you?
Good. How are you?
All good, all good. Thank you for staying with us today. And we're gonna review few topics, but mainly all of them is 4 different points studying how the industry is changing, how the business are actually evolving in a new scenarios. The first question we would like to discuss with you today is how you see the main key factors that are actually motivating the move of the industry, financial industry to Asia. This kind of pivot movement from United States to new capitals in Asia, and what exactly could be that's key factors that are motivating this move.
Sure. I think if you looked at there has been obviously a very long history of this, right? And it's really started to accelerate in the last, 10 years, 15 years. And every year now it's picking up, kind of speed exponentially. So if you looked at sort of post World War II, as Asia recovers from the war, becomes sort of the cheap factory for the world, right? People still didn't have enough money to be financial market participants, to be really middle class. People were still poor. In the last 20 years, this has obviously the dynamic has shifted. Societies in Asia became, a lot wealthier. And now you're talking about not just middle class, like the amount of rich people in Asia is exceeds the amount of rich people everywhere else, right? And I think and therefore the amount of trading, and the amount of wealth that is dedicated to trading is going to be, in Asia is going to be far higher, than anywhere else. And so I think if you look at kind of the overall, just on demographics, right, of who's becoming wealthier, you can see how GDP growth, all these things, it's an enormous amount of wealth being generated. And for decades, that wealth sort of didn't break through I got to pay my rent and I got to do kind of the bare necessities to get by. And now there's enormous amount of, wealthier people with excess savings, and those people are starting to, to join sort of the investing / trader class of people. And we've had that obviously for 20 plus years, but in the last 10 years, 5 years, this has really started to become like rivaling, Western, not capitals, if you will, countries. And I think the amount of, the population in Asia is huge. And that was always the case, but the population was huge and poor. It is now huge, but it's not so poor, and I think as that accelerates, that becomes, a huge deal. So I think kind of that, if you look at sort of the big, sort of underlying growth of this, it's economic growth that's finally really caught up to a point, right? And I think that we're now building off of, for example, look at China. Even if it just grows 5% a year or 4% a year, you're now talking about an economy that's huge. So it doesn't have to grow that much for that much wealth to be generated,
Mhm.
and I think you're getting to that level in Korea and, in all of these, Japan we've been wealthy for a while, but a lot of these places, that weren't wealthy before. And I think that the fact that you have huge countries, Indonesia, Malaysia, that in terms of population are very large, right? And countries we never thought about, Vietnam, which is not just 100 million people, but it got a very young, demographic. It's growing way faster than all its neighbors. You've got an enormous amount of countries that no one ever thought about, right, as a real market, are now going to be an ever bigger market. And you can see that already, excuse me, in real estate values in those countries, right, in the capital, right? You're already starting to see like pricey apartments, right, in places where you thought, oh, everyone's a factory worker. Well,
True
not quite
luxury.
anymore. Restaurant prices is now becoming,
Mhm.
like a real thing. So all those indicators point to, those are going to be more and more as time goes on. I think that's where the future is. I mean, it's not just in Asia. You're starting to see that in emerging markets. Like Latin America
Mhm.
is going to be a massive beneficiary of, um, you know, all the U.S. companies moving factories, to this hemisphere, right? To
Mhm.
kind of diversify from China risk, right? So that's going to be a huge, benefit to a lot of countries in Latin America. I've already seen that, in a big way. Wealth in Brazil and a lot of places, really, gone up exponentially higher. You have, again, wealth in a lot of countries in Latin America really, really jumped, right? And I
So.
think that that's something where I think it's really good. And remember, the makeup of the economy is different, where wealth would jump before in a much more heavily concentrated way because you had to have a lot of capital to make a lot of money. You had to own a factory, you had to own some real estate or something, where
Mhm.
today a lot of the wealth is being created by knowledge, right? It's technology workers, it's technology, companies. So it's really all about education, and so it's more spread out to more people. It's still, in a macro level, wealth is concentrated, but from a trading perspective, we are now have lots of knowledgeable people,
Mhm.
right? In technical fields and related fields that are making lots of money, right? And
Mhm.
those people are most attuned to the internet, most attuned to trading. So I think you've got that enormous amount of expansion. And that's why ATFX focuses on the emerging markets, not just in Asia, right? In Latin America, even in Africa and places like that, because wealth through knowledge, essentially, there's such a shortage of technical knowledge, right? That wherever it used to be cheap to have programmers, Eastern Europe, all the places where people go, it's not so cheap anymore, right? And so, the market for qualified labor is increasing. Wages are growing way faster than the national incomes, right? Because those people are being hired from companies outside those countries, right? So I think wealth is exploding in a lot of places, right? And
Mhm.
I think that that's become a huge, source of where, obviously, so that's kind of the underlying wealth, I would say. That's kind of trend number one. Trend number two that sort of sits on top of it is really the fact that if you look in US and Europe, we've had an evolution, an institutional evolution that happened alongside of the financial services industry, that happened alongside the growth and wealth, right? And it happened together for 100 plus years, right? In the United States and Europe, right? Here, you have very immature domestic financial markets. Not a lot of rules, not very deep, not very diversified, very almost non-existent bond markets locally,
Mhm.
right? Stock markets that are immature, widely concentrated in a few large stocks, right? But those have all been far surpassed by the growth in income and wealth, right? And so the domestic financial markets are not able to handle the demand, the desire of what everybody wants, the sophistication, right?
Mhm.
So local financial institutions are not sophisticated enough from a trading access perspective, from a fee perspective, and so because of the internet, you have someone who's wealthy in Indonesia, but he has access to the internet. He does not want to pay Indonesia financial services prices because that's too expensive. He wants to pay what a person in New Jersey is paying. And he can know what a person in New Jersey is paying for financial services because that's widely available on a website, right? It's no longer, the person in New Jersey 40 years ago walked to a bank branch and paid X. The person in Saudi Arabia walked to a bank branch and paid four times X, right? But same bank, right? Today it's on the internet. People don't accept it, right? They want professional, service. They want transparency. They want information, right? They want global markets at their fingertips, right? They will not accept. They consider themselves, because they are a lot more educated and sophisticated, and they don't want second rate stuff, right? So I think that one of the reasons why in our industry there's been a lot of growth, in this area, because this is where the arbitrage between what is missing in the financial infrastructure, right, of these countries, and versus what the demand and sophistication is of the people, right? And I think that that's something where that's why there's so many FX and CFD firms that are able to do it, because you're talking about there's just a huge missing link there. You know what I mean?
Totally. And so if I understand your perspective is like, for example, from a macroeconomical perspective, we know that those countries, especially in Asia, are big savers. They got a capital there. They got actually the new potential investors, because as you say, middle class is growing for the last few years there. Well, for the last 10 years mainly. I even will say that personally, from my view perspective, right, I believe that we have seen, for example, in Europe, how the middle class seems to be dropping or weaker. We got more taxes. The quality of employment is lower. The jobs are actually with the lower quality for the last few years, and that's the main concerns of the citizens. And we have seen how some of the big cities, even in Europe or United States, being honest right now here. I mean, like we have seen all of us in social networks, some images sharing by everyone. For example, San Francisco City, right, or Paris, or certain cities that we can see that they are getting a kind of degradation or involution in terms of wellness. In the other hand, we can see how Asia is getting bigger, is getting richer. And for example, I'm from Spain, right? It's a country that mainly is offering tourism services. And we have seen how the visitors to the country are 15 years ago, 20 years ago, it was like Germans, Northern Europeans. Right now, we got a lot of people coming from China, even from Russia, which clearly shows that the trend is changing. And the accumulation of capital has a big capitals is actually focused on Asia. And the last points that you were highlighting right now, I believe is like they got the ingredients for become a superpower in terms of financial services, but still we are investing the know-how, right? The knowledge on how to process the businesses, derivative businesses, and the complexity of certain capital markets there, right?
Yeah, and so there is an enormous gap in the sophistication between the population and what they demand and what the local institutions can provide. Right? And I think that is going to be a huge issue, in terms of what it costs to trade instruments, what it costs to custody instruments, to financial services costs in these countries are just way higher than what a U.S. customer would pay, right? And I think that's something that the FX industry is rectifying little by little.
It came to my mind right now two things. Like, first of all, for example, how I believe especially China has been, for example, reducing the leverage on certain assets and certain products, increasing the regulation on bank system. Still, as far as I know, for example, the capital market in China is super tight. It's really difficult to invest in China and withdraw your returns there clearly or clean. And I think one of the main reasons is because it's not actually a free capital markets there. Like you say, there is no bond market, and so far, which means, like, do you feel that the main concern of China has a main power in world? It's get too much exposed to the global capital markets and therefore be more vulnerable for any speculative movements. Let's say, for example, in the future, we have seen, for example, how these kind of movements could happen, like in economies like Russia since 2014, with drops on oil prices, and see how the ruble, the local currency, was completely dropping against the dollar, do the movements in commodity markets and so on. I believe China they are always planning long term whatever they're doing, and probably the financial markets, the financial service and financial industry in China is something they are cooking slowly because they don't want to open so much the business there in the main concerns, like probably the exposure they could have could generate certain volatility in the capital markets inside of China.
Yeah, and obviously they're extraordinarily afraid of short-term shocks to the system, right? And they have less of a safety net in case there's a big recession. There's a lot less tools to deal with, with the shocks, so they're trying to prevent it. But overall, restricting capital, like restricting the flow of capital, is not an effective way, and the market is going to have always this very restrictive nature to it because people don't believe they can take money in and out quickly, right? So it actually is counterproductive at this stage. It's counterproductive because remember, if you are a small country in Latin America or Africa, you'd be more concerned about large amounts of money from overseas twisting the economy, right? But China and places like that are much more, much bigger today and much more able to handle the free flow of capital. So, obviously it's not in their nature yet to allow this unfettered movement. It's not philosophically what they see. And it requires more financial discipline, more geopolitical discipline that they want to have right now. So, it's hard to do, right? So they don't, not have the same situations like the Russians have. But at the same time, those are all, I believe, temporary things. If you look at a 50-year trend, right, the fact is, income levels and sophistication, like information, availability, has grown to such a degree that those things are an inevitability, right? That if they want a mature financial market, they'll get there. So I think that's something that, it's not tomorrow or anytime soon, but I think it's getting in, it's going in the right direction. And frankly, what's going to happen is some of the other countries around China are going to catch up very quickly, right? And that's going to kind of force, this reckoning, that's going to happen because they will be with less baggage geopolitically than the Chinese, right? And so just able to do a lot more stuff. So I think that the rise in Vietnam, right, in Indonesia, in Malaysia, and in Thailand, in all of these countries is going to be, fairly, I think it's going to change the game, right? Because we're talking about hundreds of millions of people.
Yeah, right? Completely. And so, but like you say, from a macroeconomical perspective, because either they grow with China by irradiation of the Chinese economy, which is what happens right now. South Korea, Japan, which are economies like in theory, they are not so politically linked to China. They start to depend on China, on the inputs on China, because the trade balance of these two countries, South Korea or Japan, is right now moving depending on the expectations from industrial production from China, which is very interesting. Like emerging countries, like you mentioned, also those countries, the main investor right now is China. I mean, in Latin America, for example, I believe the only exception is Mexico, which is super close, but the rest of the countries, China overpassed United States has a principal investor there. So obviously they are influenced and irradiating all this economical influence in all the countries, including Australia, even, or New Zealand. Right now, they got strong links to the Chinese economy. If the Chinese economy is slowing down, concerns start to grow up in Australia about what's going to happen, because the main partner they got right now in Pacific Ocean is Asia, and exportation is
well, absolutely. You've got China's the second largest economy. So it used to say, the U.S. catches a cold, everybody else gets the flu. The Chinese are essentially, stepping into those shoes too. And specifically, if you are, as a country, in the supply chain of manufacturing, that's where the Chinese investments, right? So the Chinese are trying to secure the raw materials, the energy. That's why they invest in the countries where raw materials and energy that's where they're going to be dominant, because they got to feed an industrial base, where the United States is, got a much smaller industrial base. And so I think that if you look at that perspective, when China catches, is having a huge impact, that's going to be a huge negative impact, right? It's going to be a big negative impact on um, all of those people in that manufacturing ecosystem, the mining, the energy production, all of that stuff. So I think there's a lot there, but again, what it's done is really democratize wealth everywhere, right? So like the growth of Chinese industry has led to a lot more wealth in Australia, a lot, because of mining and energy, a lot more wealth in Brazil and all these other, in other places because of the growth of China. And so like there is, and not just, and so as you'll see India, get there. So it will help, too, right? So I think people are forgetting that, we used to look at global financial markets. We used to essentially rely on 50 million to 100 million investors, traders from US and Europe, maybe more, a little more, right? In the next 20, 30 years, we could be introducing 500 million.
Wow.
Right? From Latin America, Asia, if you take India, China, all of these countries together and say who's going to get to this level of being an actual trader, like it's hundreds of millions of people. So I look at that again in the long term horizon. If I look at that's insane.
But
Right?
even one thing you mentioned at the beginning, which is how the speed is changing also in this economy, because we are talking about a digital economy, the information, everything is growing exponentially and faster than we could expect 5 years ago. So even the projection of like maybe in 15, 20 years, we're going to get to this point, sometimes could change. Things can change like dramatically in a shorter period, because the things are getting escalated so faster than we could even expect. Because now in our days the money is moving like a light speed, right? I mean, it's completely, except which is taking us for the second question, and it's the main threat: regulation. How we gonna adapt to, especially those countries, how they gonna adapt to a new regulation for financial markets from a business perspective also, and most importantly, because I know for the audience probably all of these topics, regulation could be interesting topic from a business perspective, but also there is another factor that is more spicy, more noisy, which is the trade war. And potentially, if Donald Trump, for example, become the new president of the United States and he go to the trade war 2.0, I mean the next level, the next evolution, which by the way, Biden administration has been keeping the restrictions on certain companies and the sanctions against certain companies like microchips and so on to China. But if these things are coming, do you think we actually could say, well, the main question is how exactly we are going to adapt that regulation in Asian markets are going to affect the business? And I will say that the second question, linking to the first question, is now if the trade war is actually a potential risk for a kind of de-globalization or de-escalation of globalization, to a step back in that globalization and actually start to, because we have seen how Europe, United States has been increasing new barriers on trade, new sanctions, more paperwork, more bureaucracy and more taxes to avoid free trade between regions. And China is the main actor right now promoting the Road Belt Initiative, the new free trade the biggest ambitious project ever done with free trade between Asia, Middle East, Africa, and even south of Europe. So I guess this is the question, like how we are going to adapt to that regulation on those countries, which essentially you already reply in part, because you mentioned that they are still in a kind of a really early stage in terms of the evolution of the stock exchange there and so on. But do you think it's actually possible, or we are actually going to face a kind of a transition where there is going to be more tensions from a regulatory perspectives in trade and worldwide trade?
So I think two separate questions. I think if I look at trade war, geopolitical kind of trade issues, and their effect on our business, I'm not going to go be an expert on what's going to happen, but if you look at it I look at it as a diversity, like, okay, if we're a company and we say, as ATFX, can we bet the farm on China, or do we have to diversify? So ATFX took the decision, even though it has a huge China-based business, to diversify outside of China, right? And because of this type of stuff, is because why you can't be dependent on one place. And that's the Apples of the world also too dependent on China, and said, okay, how do I not do that? So I think the biggest, if there is more issues between China and the United States, as an example, right, then the biggest beneficiaries are India, Vietnam, Mexico, Brazil. Do you know what I mean? And like you essentially, you're just pushing people, right, from one. It's not going to happen, right, that the Italian company that outsources stuff to China is going to go back and put this in Italy, right? So whatever they outsource, they're still outsourcing. They're just, where they outsource is going to be different, right? And so that's why you're seeing a lot of growth in a lot of places, right? that traditionally did not have a lot of growth, because you're seeing a reallocation of capital.
Absolutely, absolutely. Actually,
Right.
one of the best examples, it was like last week. They announced, for example, that one of the strategies China was proposing to European Union to avoid the new taxes on electric vehicles. It was okay, fine. Let's produce the electric vehicles in Europe. So they open in Hungary. I think it was Hungary, Poland, and Spain. The three countries they announced they were getting interested to, for example, reactivate in Spain Nissan fabric in Spain to produce cars. They could actually recycling this place just to start to produce electrical vehicles from a few Chinese companies there. Even in Hungary, they opened in the last 9 months a new battery producer industry there in Hungary, in Debrecen. So you can see that the strategies are, like you say, they reallocate the business, they diversify the capital and say, okay, if we need to deal with certain new barriers on the trade, we can even be open to invest locally in your economies, locally open new business there. And even the foreign minister of China a few days ago mentioned, well, you just, oh yeah, it was after the NATO meeting in Washington, D.C. They define like the new geopolitical risk in this polarization of the world right now between China, United States, Russia, and Israel and Iran and so on, well, Ukraine. So we can just continue with the queue, because it seems to be the conflicts are growing like mushrooms everywhere. But unfortunately, but one of the main points, and they were saying, is like how exactly we can deal with this situation. And the foreign ministry of China was saying, like, we are going to your countries, we're investing in your economies, we are creating jobs in your economies, we pay your taxes, so we are part of your economies. Like we are integrating the investment flow.
Is a Japan playbook in the 80s.
Yeah.
Right? All the anger about Japan, and if you look at
Very
like
interesting.
1980s movies, right? There was a lot of, Japan is taking over the world, Japanese car companies displacing American car companies, European car companies. So they basically went and put car factories, right, in the United States to take out all that political anger.
I didn't see in that angle. Yeah, that's true. That's true. I didn't see in that
So
angle. Very interesting.
yeah, the Chinese already know the playbook, because Japan already wrote that book a long time ago. So there's a lot of things that are happening the same way, right? Because a lot of the anger is that that if you look at the stuff in the news, a lot of it is the same, right? And obviously a lot of stuff is different. The geopolitical angles are different. The Japan never had the has not had the issues, the geopolitical issues, right, as a competition, but as an economic competitor, it was considered a huge threat, right?
Yeah.
And that they went and they disarmed it, right? So I think that when I look at like the politics of it, you can't dismiss it, because it's a real thing, and I'm not an expert there, but I
Yeah.
will tell you that
So
I see it from our perspective as, like most companies, you just have to diversify, right? So if China's going to take a hit, then you have to be in India, or you have to be in Vietnam, you have to be in all of these other places,
Bangladesh, yeah,
right? All
which
of
is
these
like you
things.
say. these emerging countries, which at some point could be an alternative for if the regulation start to build walls between the economies, you can simply go to one place to another to replace this. Which I think even with the trade war during the Trump administration, one of the countries that we were suggesting has a plan B was Vietnam or Bangladesh to keep producing in those countries instead of China, just to reduce the exposure dependency on China. So yeah, but like you say, we cannot, from a business perspective and especially from financial industry where we are right now has ATFX. What you mentioned is like we try to basically be in absolutely every single regulation, every single market, diversify, playing the game by the rules in every single place, and try to be with the flow. So as far as they let us play the game and make business, we will keep doing the business. Which bring me for the last question, which but more or less, I think we have been touching those topics. What do you think is the main challenge we are facing in the future in terms of the financial business and industry in Asian markets?
So I view the immaturity of the infrastructure in Asia makes it very vulnerable. So I think if you look at the last 72 hours, the last 4 days, right? It's a great example. You have a lot of dislocation in financial markets, right? Nasdaq falling, everything. But look at how much the Nikkei fell, right?
Mm-hmm.
And look at how much, and then some of that has to do with the carry trade unwind and the yen and stuff like that. But if you look at what happens, there's less younger financial instruments in general, like crypto, like stuff overseas, have less liquidity, have wider spreads, becomes much worse to trade when things get really bad, right? So one of the problems that happens, when financial markets are in turmoil, investors, traders, everybody wants to go. Where is the most liquidity? What's still cheap to trade, right? And that is concentrates into the most liquid instruments, right? One of the interesting things about the way if you look at what a lot of the way ATFX and its competitors handle it, primarily we are selling Western financial instruments to an emerging market consumer. So the reality is actually we protected by their choice of choosing gold, Eurodollar, Dow, those type of instruments, right? They're safeguarded from the catastrophes that is, some regional stock, right,
Mm-hmm.
in those countries, right? And I think that if this crisis is not some momentary correction, it becomes a 3, 6 months, 12 months, 2008 type scenario. And even if that doesn't happen now, it could happen, given debt levels in the world, like there's enough reasons why a 2008 could happen. And when it does, not if, when, right? It is safer to be in the most liquid, places, right? So I think one of the inadvertently, by not having a mature financial market, and these investors relying on Western financial markets and essentially piggybacking into Western financial markets, right? There, for all intents and purposes, are sheltered from some of the worst problems that would happen to a local financial market. Do you know what I mean? Because so many of them are exposed to the Western stuff, right? And so we're just going to get hit less, right, from that perspective. So obviously, local real estate's going to suffer, and that's a local phenomenon, and local stocks a local phenomenon. But people who are trading, who are trading, not investing, are trading Western instruments, they're going to go and going to have the same impact as Western.
I get it. So mainly it's like, paradoxically, even with the evolution of Asian markets, still any risk factor globally is gonna attract more capitals to the traditional assets like risk-free bonds in United States. Again, stay in dollar. Again, I don't know, like choose like for example certain big sectors in the economy in the US market, because they are the biggest ones, the more liquid ones, and well, with the exception with if they are too big to fail or to fall, right? But in general, like
And it's easy to take so much money in and out, right?
yeah, true,
So
like
the
you can get out.
problem becomes when you are in a small market. Even go back to 2008, right?
Mhm.
Italy, Spain, all of those markets, right, implemented shorting restrictions,
Mhm.
have all of this stuff, right, have a million issues. Why? Because, they couldn't handle the volatility. You're talking about stocks that were super vulnerable because it was a very immature, financial market, right? That's just from a size perspective, right? And that is a very, very difficult thing. So obviously, you have huge headlines because, the Nvidias of the world are worth so much money. So when they move up and down 10%, like it's trillions of dollars. Do you know what I mean? When Apple and Nvidia, all these things. But like there isn't in the scheme of things, the volatility is just normal, right? This is
Mhm.
when, there's too many leverage speculation in the same direction, right, in these instruments, so they have to correct at some point, and the correction is never pretty,
Totally.
right? But
And
it
in the
sounds
in
more
defense,
dramatic than it is.
and also in defense of free market, one thing I remember, I was studying in financial industry. I was working at trading desk by 2010 when Greek went to bankruptcy. They got a default on the bonds, and I remember they start to activate all these restrictions you mentioned, that avoid like short on European markets. And because I was working at trading desk, all the calls I was receiving to sell or to short certain assets, well, you cannot do it anymore. Even blocking certain positions of clients, and if they want to get out from the position, they need to explain why and send a letter and stuff like that.
Yeah,
And which is, but the thing is, instead of stop the drops on the market or the falling on the main values, what they were causing is it was more panic, because people say, well, if they blocking the transactions, if they taking this kind of extreme measure, it means we are in a really, really bad situation, which is
right.
what I believe, like has much restriction you start to put in place to the trade, especially in situations that the market is falling. Certain measures can actually confirm the worst scenario that people are keeping in mind. Like, oh, this is the end. This is the new crash, and we're going to I don't know, to lose all our savings. And then what happens with the authorities? No, you cannot touch your savings. You cannot access to your funds. You cannot. Wow, then this is real. It's happening. You know what I mean? So.
And it's even worse than that, right? Because in a free market, when the prices are falling, right, okay, so there's people who want to sell have sold or are selling, right? But at some point it stops falling and it's stable, and then you can see, okay, the on the news may not be great, the price is lower, but the big sellers who wanted to sell have sold. When there's restrictions, you don't know how many more people needed to sell and can't sell. So every time if I'm going to buy, but there's 100 more people wanting to sell and need to sell
Yeah,
and
true.
already made up their minds to sell, they just can't, right?
So you mean like only short traders are the ones who are gonna buy at some point if they want to
Right.
make profit. So they the main buyers at the end of the day. Even the ones who are short in the market, they need to buy at some point to make the profit. So
Right. So they will stabilize it, right? And then, so the beauty of, you know, if you look at, the apples of the world, they will fall, fall, fall until the imbalance between sellers and buyers changes the other way around. And that happens all the time, right? We've
Mhm.
seen very violent falls, but it always turns because, the balance turns. So I think that's something where that's always the risk of investing in immature financial markets, right? Is the government is more prone to make very serious mistakes, right? To make things worse. Like for example, the United States shut down the stock market. I don't remember for how long, 4 months or 5 months at the beginning of World War I, right, in 1914, right? And that is not exactly like the thing you're supposed to do because they're worried about it falling so much, right? And it would have fallen so much, but it would have recovered, right? By shutting it down,
Yeah.
you
You
know,
try the liquidity on the economy.
yeah. And so
Mainly.
people freak out, and so, the reason we got the Great Depression after 1929 is because just terrible policy after our stock market crash, and obviously all the other issues in between. So in Asia, we this is the main risk. It's why you cannot say I'm going one country and I'm going to bet that country, because you never know what regulation is going to be there, how the government there will react to a crisis, right? And that is, we don't know that, right? But like those are the, that's what makes the world, interesting, right? Because there's a lot of unknowns. But I think that there is if you're looking about risks in Asia, is when the rules come, they're very quick, they're draconian, and the governments there don't have the experience to deal with financial stuff, right? So they get very, very nervous really quick, right? They don't trust the system.
Mm-hmm.
So that's always the risk. That's why you have to, which is why I think at the end of the day, what we bring to a place like Asia is the ability to isolate out of that local risk, right? Right? You're coming and you're saying, okay, I want, all global stocks are correlated, right? If you're investing in stocks and investing in the stock of this country and that country, when things are going on, there's no difference. They all move the same. Some more than others, but
In general,
when
yeah,
the
there is
US
no.
is going up, China is going up, and vice versa, right?
Exactly.
So the reality is, if I want to bet on equities going up, right, or down, right, might as well do the Dow. Why I have to worry about, the thing. I have Dow, I have the Nasdaq, I have the DAX in Germany. I have proxies in the West, right, that are more stable, more liquid, have tighter spreads, right, are just better proxies, right? Like gold being a proxy for like the anti-dollar. Do you know what I mean? I want to short dollars, I go long gold. I want to, go long dollar, I go short gold, right? Like, so it's
Rebalancing constantly
yeah, it's a
there.
rebalancing. It's why you look at most Asia-based brokerage firms, more than half the business is gold versus dollar, right? Because that's what everybody understands. That's what everybody knows, traders back and forth, right? And that's a super liquid trade and relatively stable. Not as stable as Eurodollar, right? And so, for example, Euro versus dollar. So if you looked at number one traded financial instrument in the world in the institutional space, is Euro versus dollar. In the retail space, it's gold versus dollar, right? So the institutional market, because it's much bigger, Eurodollar spreads are going to be tighter, right? And more liquid, and gold is going to be much more noisy, all over the place, more volatile, because it's more of an amateur instrument. And the thing that most investors, retail traders, don't understand is the real trading market for gold is unfortunately like 5% of the size of the synthetic B-book market in the retail FX industry.
In Eurodollar.
Right? No, in like gold versus institutional gold. Like gold.
Oh, okay. Oh, yeah, retail.
Gold, right? Where in Eurodollar, the market's massive in the institutional business. And so you can support any level of crazy Eurodollar trading in retail by the Eurodollar institutional market, back to back the whole thing if you needed to, and you're fine. In gold, the industry could not do that if it needed to offset everything.
You mean they cannot pay completely 100% the positions, right?
No. So it's very risky, But again, if I compare it to local Asian instruments or instruments in Latin America, it's way less risky than that.
Yeah.
And so, you own an apartment, in like we were talking about during you say about the Greek financial crisis, right? During
Mhm.
apartment in Cyprus in 2010, and it just froze the banks and the
and
savings and everything.
and they
Your
caught all the
retirement just
accounts
goes
over.
zero.
Yeah,
You know?
and they intervene the accounts. It's like some people are saying this is the Soviet European Union because they will
Yeah,
intervene every single account with more than 100K on deposit.
because basically the banks are bankrupt,
Uh-huh.
right? And
Yeah, but they
so
take the
that,
private money from citizens there.
but it was those are the risks that you have in those markets, right? And
I
people
see
have
the
to
point.
look and say, okay, I have
Uh-huh.
that,
Like
but I
watch
don't have
out.
this risk
Yeah.
trading Dow versus US dollars, right?
Mm-hmm.
Now, you have the risk of your retail FX provider going out of business. That
From a
is just,
regional perspective, right? If in
yeah,
case the country taking place these potential crazy measures you were saying, like not even in Asia, but only even in Europe during the crisis, financial crisis, we have seen these things. So it will be normally even in Asia by any liquidity risk they start to put in place certain measures that scare the investors. I
right.
think I think it's a really clear picture of all we have been touching all aspects from a business perspective, from a global perspective, macroeconomically, microeconomically, from a retail investors too, and we also have mentioned what could be the main risk on Asia. So Drew, Chief Strategy Officer of ATFX at Florida, US. Thank you so much for today. I
My
think we got in
pleasure.
the agenda few topics to discuss. I really found really interesting this one. I guess I hope we're gonna be here again soon to discuss
Mhm.
new topics with you. As soon as you got free time to bring us a few minutes here, will be amazing. And I got the feeling that you really enjoy, right?
Yeah, yeah, yeah.
Open
And
this
we
book
will
and
next time we'll do more deep, like
all right,
tactical stuff that is
sure,
more relevant to traders. So we'll do less macro,
absolutely,
that.
absolutely. Drew, thank you so much for
Thank
your
you.
time. And hopefully I hope to see you better next time for with new topics. Thank you. Take care.
Thank you.
Bye bye.